All right, welcome back to Simply On Chain. If you are looking for a more data-driven approach to your investing using metrics that have been proven from cycle to cycle, this is the channel for you. As you may have heard, the BlackRock Bitcoin ETF options have recently started trading this week. This will undoubtedly have a huge impact to the crypto market. For now, I just want you to look at what happens to the price whenever there is a spike in the futures funding rate in green. In January 2021, there is a spike in funding rate, price rallies, then it's followed by a sharp decline. The same thing happens in February. There's a huge spike in funding rate here. The price continues to rally, followed by a huge decline. You'll see the same thing happen again here in March and here in April before the start of the bear market. Now that we have a little preview of the effectiveness of this metric, let's dive into the agenda for the day. First, we will explain what the perpetual funding rate is and why it works. Then we will do a chart overview and do a deeper dive of this metric within each cycle. Finally, we will talk about the current market and where we are headed. So what exactly is the futures funding rate? The futures funding rate is used to keep the contract price close to the spot price. Positive funding rates mean traders are betting on Bitcoin going up. This means that they are taking a long position. To balance this, longs pay a fee to shorts to incentivize more short positions. This is what you need to know. Positive funding means the market is bullish. High funding rates signal over leverage, which increases the chance of a reversal. Whales monitor these rates, force liquidations by selling, then they buy back in lower. Now let's do a deeper dive by taking a look at this visually on a chart. Since futures are a newer product, we only have data starting from the last bull run, so I'll zoom into that now. The green on this chart is the funding rate, and the y-axis for this is on the left. The white line is the price, and the y-axis for this is on the right. Let's use the 0.12% funding rate as a threshold for spotting an area where there might be potential liquidations. In early January, the funding rate surpassed the 0.12% threshold. The longs caused the price to rally to about 41K. Whales saw this and took advantage of the situation by causing a liquidation down to about 31K before buying back and starting the next rally. When the next rally started, bullish sentiment got super heated. Funding rates surpassed 0.18%, which caused the next leg up to a price of about 57K. And again, whales saw this sentiment and took advantage of the leveraged longs, sold there, caused the price to drop to 44K before buying back for the next leg higher. In mid-March, the funding rate surpassed the 0.12% threshold again, causing a local peak in price. Whales took advantage of the leveraged longs and caused the price to drop down to 53K, repeating the process again. Note that there are times where the funding rate will spike and it doesn't actually always follow this trend. This is because derivatives are only one part of the story. This is why you should combine this with other on-chain metrics that I have talked about before in my previous videos to get a more holistic picture. Now let's take a look at the current bull market that we're in. Earlier this year in March, the funding rate surpassed the 0.12% at around 72K. The price went on to rally to 73K before whales took advantage of the situation and sent the price back down to 62K. Recently, there was a spike in funding rates here, but it has not surpassed the threshold that we have set. I personally think we will surpass 100K sooner rather than later. And that's it for today's video. Make sure you combine this metric with other on-chain metrics to get a more complete view of the crypto market. And I'll see you on the other side of 100K.